Hi guys, welcome back to the channel. I hope everybody's doing good. If you're someone like myself who has a stock portfolio of individual stocks, you'll likely have noticed a stark contrast in performance depending on the market cap of your company in the last 12 months or so, as small cap growth stocks have been decimated in this high inflation, raising rate environment. Long term, I feel that these three companies can offer fantastic returns, but please be aware how volatile these small cap stocks can be. I do own the first and last companies that I'll be showing you here today, just for full disclosure. Stock number 1 is Alkaline 88, who are a high-end water company specialising in bottled alkaline water. These come in various flavours and also various sizes to help appeal to individual customer needs. They've also branched out into the CBD market under the 888 CBD brand. Alkaline 88 offer their products through convenience stores, national retailers, as well as through e-commerce sites. They've been around for 10 years now, as they were founded in 2012 and based out of Arizona. Alkaline 88 show a visibly pleasing growth chart and been able to grow revenue every single year, projections still forecasted out to 2023 and beyond. Revenue in 2017 was 12.76 million, with forecast by March 2023 that this will be around 80 million, which in 5 years to grow this quickly shows the demand is there for their products and that the company have been doing a pretty good job in being able to scale their business. Although we have the impressive top line growth, they still do make a loss and not currently profitable. This isn't to be entirely unexpected, as in order to fuel growth through distribution deals and higher input costs, this is obviously one of the risks in owning these type of companies, that they don't currently make a profit, and during these tough times that they either need to raise cash either through debt or through issue new shares, diluting current shareholders in the process. Alkaline 88 listed on the NASDAQ on the 4th of December 2018, and it's been on a downward spiral ever since. From being almost a $4 stock, it's plummeted to 50 cents during the COVID lows, and it's been pretty range bound between $1 to $2 since 2020. Balance sheet health is pretty average in terms that assets do outweigh liabilities. Currently have about 9 million in cash with 5 million debt, but shares have been heavily diluted in the last 4 years, from 26 million in 2018 to 87.5 million in 2021. One of the attractive propositions about this company is its valuation. It's a high growth company, registering 30% growth most years, but yet when you compare the price to sales ratio to Coca-Cola, it trades at such a discount, with price to sales coming in at only 2.2 over the last 12 months. Let's start to take a look at what's been happening in this company and see if we can identify the bull thesis to support revenue forecasts. Firstly, they have Shaquille O'Neal as their brand ambassador, who's been given 7 million shares over the last 3 years, making Big Shaq the largest shareholder. So what do Alkaline 88 get in return with this deal? Well, they now have marketing to 21.2 million followers on Instagram, and through the power of his brand, when you look at the YouTube views in the first 2 videos, it's pulled through more than 220,000 views. One of the ways that I like to look into this company is through customer feedback and reviews, which is easy enough to do via checking the reviews left on their products. On Amazon, when checking the 500ml and 1 gallon products, it shows that both of these have a 4.5 star rating across 723 and 230 reviews respectively. The list of stores that they have their products on their shelves is ever growing and includes some big names like Walmart, CVS and Kroger, just to name a few. The growth, well, all you need to do is look at this chart, which is showing a combined annual growth rate of 52% since 2015, and this gives me a sense of excitement on where this revenue can go over the next 5 years. Touching on that feedback side again, their water brand connection has over 50% of their customers reporting that they love the product, and in comparison to other brands it's the highest. And please pay close attention to Essentia results, which is the 4th in from the right hand side, as this is super relevant. Nestle acquired Essentia Water in 2020 for an undisclosed fee, although estimations are that it's about $500 million to $1 billion, and Essentia at the time was reporting revenue of $120 million, which is where Alkaline 88 should be in the next 3 to 4 years. Which follows me into my next point, which is where I see this company as being an ideal acquisition company for one of the larger brands over time. Reading the highlighted section, Alkaline 88 CEO Richard Wright, in the earlier part of his career, was spent at one of the big 4 accounting firms, where he was the regional director of the tax and financial planning. As a former CFO, CPA and entrepreneur, Mr. Wright has extensive knowledge of finance, operations, sales and marketing, and has participated in hundreds of merger and acquisition transactions throughout his career, and I think that last point is the key point here. So if this doesn't look like it's set up to be purchased at a later date, I don't know what does. Via tip ranks, the price target is $2.50, with only one analyst on it for the time being, likely because it's a small cap company, and if they are correct, you would get a nice return of about 122% from current levels. Stock number 2 is a company called Aterian, who operate as a technology enabled consumer products company. They provide artificial intelligence Mohawk e-commerce engine known as Amy, which is a software technology platform which has used machine learning to design, develop, market and sell products. The platform sells home and kitchen appliances, kitchenware, heating, cooling, health and beauty products and air conditioners, as well as other things under various brands such as HomeLads, Vremi and Muller. The revenue growth from 2017 till now has been really impressive, jumping from $36 million to $240 million, which is expected this year. They still don't make a profit majority of the time, with forecasts expecting this to improve over time. The share price is down over 50% from when it listed in 2019, but look at that run up it had in 2021 where it went to almost $40 a share, and it has come crashing back down to reality. The balance sheet isn't perfect by any stretch of the imagination, but assets do outweigh liabilities, and debt has been doubling though, from 27.5 million up to 86.5 million in only 3 years. What makes this an interesting pick is the super low valuation based on the price to sales ratio, and this is hovering around the 0.59 mark, meaning that this could quite easily double and still not be overvalued going by this metric. Amy, their machine learning AI integrated into the company, shows how through all stages Amy is used. First they use the consumer demand data to create new products and improve on existing products, then onto the marketing and sales side of things, and finally onto logistics and inventory, where the cycle repeats over and over again, each time hopefully improving and learning more data. Amy looks to be fairly successful, as revenue has been increasing tenfold from 18 million in 2016 to 185 million in 2020. Fixed cost to the percentage of the net revenue has come down quite drastically from 44% to 12.8%, showing that this tool can improve efficiency. This gives an example of two of their brands, Home and Vremi, with some of their current products. We've got air fryers, indoor grills, air purifiers, and what I like here is firstly the amount of reviews on each product, but also same again as the previous company, these products are getting rated at 4 stars on most of their products here. Aterian's latest results were out in November, so we'll run through some of these facts. Revenue grew 16%, gross margins improved 50.2% from 47.8% a year earlier, operating expenses almost doubled to 41.7 million from 28 million, EBITDA of 700,000, they decreased from 5.1 million last year, and no new products have been launched opposed to 8 last year. Total cash balance right now is 37.5 million, and this is down 24.4 million. Revenue is up, but profits are down in a big way, and there may be a reason behind this. The section I have circled in red mentions that this quarter was an all-hands effort to stabilise the business and strengthen the balance sheet so that they can continue their growth trajectory. And it mentions that the shipping cost from China to the US skyrocketed over $20,000, so this obviously has been a huge factor in their business model as they were forced to raise prices to help offset this. Quite a lot of challenging factors for Aterian here, especially since they're so heavily reliant on cost-effective shipping fees and ample supply chains. So make no mistake about it, we do have a lot of headwinds here, but with this super low valuation, it could be a trader's dream. We've got a price target from one analyst again, and this is at $12, giving a whopping 212% increase from current levels. And finally, stock number 3 is none other than GAN, who operate in the internet gambling realm, providing online gaming solutions for casinos as well as online sports betting. They also offer internet gaming, internet sports gaming and virtual simulated gaming and online peer-to-peer poker services through its CoolBet website. They pretty much offer a full end-to-end experience for online gambling. GAN have been working hard to increase their revenue and have been successful especially in their acquisition of CoolBet, which looks to have been a stellar piece of business. Revenue is forecasted to come in at over 120 million for 2021 and then exceed 160 million in 2022. And this is still only a fraction to where the company sees itself in a few years' time, which we'll get into shortly. The share price has been hammered and now at all-time lows. At $7 a share, it's coming in at a market cap of 321 million, which is too cheap in my opinion for an online sports betting tech company, especially when you can see where it's been trading previously, when it's been up close to $25 on a few occasions. When we compare its valuation to DraftKings, the price to sales of only 3.5 makes this a very cheap price as of right now. Latest reports show that they still have 50 million in cash, down from 152 million last year, mainly due to their acquisitions. Liabilities have doubled from 17 million to 35 million, but this is certainly nothing to worry about due to the ample cash position they're still sitting on. As I touched on earlier, the purchase of CoolBet for $176 million has been a fantastic move. By doing this, it's increased GAN's revenue 263%, which of course is great news for the underlying fundamentals of the business. Another slightly low-key purchase is this deal with Silverback Gaming, in which they have exclusive content rights, and it's expected that this portfolio of gaming content will include a further 50 new slot games across the next 3 years. Up until this acquisition, Silverback distributed its content portfolio to over 100 B2C operators across Europe. The company themselves have set pretty ambitious revenue targets over the next 4 to 5 years. In 2023, revenue is expected to be 225 to 250 million, and then 3 years after that to be between 500 million and 600 million, which when you think of this sitting right now at a market cap of 321 million, longer term this company could easily be worth $1 to $2 billion in the future. Looking at this industry as a whole, expectations are that by 2025, sports betting could be worth 11.6 billion and the iGaming market could be worth 7.8 billion. These numbers were created on the basis of 27 jurisdictions where sports betting is legal, with expectations of it being 35 by 2025. And to round off this video, we have a price target from one analyst again on tip ranks, with it being $14 for this stock, giving a nice 83% increase from current prices. I do strongly believe that although these stocks are being battered right now, in the next 2 to 5 years this could be potentially be looked back on as a good time to have picked up these companies. I hope you've enjoyed a look into these companies, and I'll catch you all in the next video. Thank you.